Now coming down to profit planning. Sum number 10 related to profit planning. So ambitious enterprise is currently working at 50% capacity and produces 10,000 units. At 60% working, raw material cost increases by 2% and selling price falls by 2%. At 80% working, raw material cost increases by 5% and selling price falls by 5%. So 50% is my current situation, and 60% and 80% is the situation which they are planning to go for it in future. So they have given me details related to material and details related to selling price. I need to work them out. At 50% capacity working, the product cost rupees 180 per unit and is sold at rupees 200 per unit. The cost of rupees 180 is made up as follows. So material, wages, factory overheads, administration overheads, the cost details was given to me. Prepare a marginal cost statement showing estimated profit of the business when it is operated at 60% and 80% capacity. So by using current situation, what I am supposed to do is I am supposed to prepare my marginal cost statement for 60% capacity and 80% future capacities. So the question is very easy. I'll be taking this material, wages and factory overheads and I'll be noting this down in my 50% capacity. Where my selling units are 10,000 units, so I'll be multiplying per unit cost with my number of units. So I'll be getting material, wages, variable overheads, factory overheads and admin overheads. This total cost I'll be getting straight away from the question. Your per unit is given to me, so I'll be multiplying. I'll be taking this and I'll be multiplying with my number of units. Okay, so 100 rupees is given to me, so 100 into 10,000, that will give me 10 lakhs. 30 rupees is given to me, 30 into 10,000 will give me 3 lakhs. Here 30% is given to me, so out of this 40% is fixed. 30 rupees is given to me, out of that 40% is fixed, 60% is variable, so 18 rupees is my variable cost. Into 10,000 units will give me 1,80,000. 1,80,000 as my factory cost. Coming down to admin. So what is admin cost? 20 rupees is my administration cost. Out of that 50% is fixed. So I'll be taking 10 rupees as variable. Okay, and that I'll be multiplying with my number of units. I'll get my total marginal cost. This I'm supposed to subtract from my sales. That will give me contribution less fixed cost, that will give me profit. Okay, now coming down for 60% capacity. So 60% capacity is easy. At 50% my units are 10,000. At 60% my units will be how much? So if I cross multiply, I will be getting my number of units at 60% capacity. Okay, so here it will be 10,000 into 60 divided by 50. That will give me 12,000 units. That will give me 12,000 units. Okay, in the same way, I'm supposed to work down for 60% capacity and 80% capacity. Okay. That will give me total overheads, factory overheads and admin overheads. So I just took my expenses at 50% capacity, factory overheads, fixed and variable, admin overheads, fixed and variable. That's it. Now coming down to next topic, that is transfer pricing. So what is transfer pricing? Transfer pricing is the price where my goods are transferred from one department to another department at a selected price. So a transfer price is that notional value at which goods and services are transferred between divisions in a decentralized organization. It is a notional value, assumed, imaginary. In modern days, production is on mass scale due to technological advancement and upgradation. Organizations grow in course of time, and for such growing organizations, decentralization becomes absolutely necessary. And because of the decentralization, transfer pricing has become necessary in a highly decentralized companies where number of divisions or departments are created as a part and parcel of the decentralized organization. Transfer pricing is nothing but a tool which management uses for measuring the performance of divisions or departments. Methods of transfer pricing. There are four methods of transfer pricing. So actually there are three methods. First one is pricing based on cost. Next one is market prices, and third one is negotiated pricing and pricing based on opportunity cost. Now, price based on cost is further divided into actual cost, cost plus method, standard cost, and marginal cost. There are no further divisions for market pricing, negotiated pricing, and pricing based on opportunity cost. Let's go for sums related to transfer pricing. So my first sum number 11. Following information relates to budgeted operations of Division P of manufacturing company. Sales 50,000 units at the rate of rupees 8. Variable cost at the rate of rupees 6 per unit. Contribution margin less fixed cost and divisional profits. The amount of divisional investment is rupees 1,50,000 and minimum desired rate of return on the investment is the cost of capital of 20%. So they have given me divisional investment of 1,50,000. Cost of capital is 20%. Sales and variable cost, fixed cost and contribution details are given to me. Calculate divisional expected ROI and divisional expected RI. So ROI is how to calculate divisional expected ROI. It is nothing but my divisional profit 25,000 divided by my investment, divisional investment, that is 1,50,000. Divisional profit 25,000 divided by 1,50,000. And divisional profit is nothing but 25,000 is my divisional profit, and 20% of 1,50,000, 20% is my cost of capital, 20% of 1,50,000. So if I take a difference of this two, 25,000 is my divisional profit given to me in the question, and 20% is nothing but cost of capital of 1,50,000. If I subtract this two, I'll be getting negative 5,000. Then comes illustration number 12. Company has two divisions, X and Y. Division X manufactures a component which is used by Division Y to produce a finished product for the next period. Output and cost have been budgeted as follows. So component units given to me is 50,000. Finished units given to me is 50,000. So there are two divisions, Division X and Division Y. They have given as units for both the divisions. Cost, variable cost is given to us for both the divisions, and fixed cost is given to us for both the divisions. Fixed costs are separable for each division. You are required to advise on the transfer price to be fixed for Division X component under the following circumstances. Division A can sell the component in a competitive market for rupees 10 per unit. Division Y can also purchase the component from the open market at that price. So Division A is planning to sell the component in a competitive market for 10 rupees. As per the situation mentioned in A above, and further assume that Division Y currently buys the component from an external supplier at the market price of rupees 10, and there is reciprocal agreement between external supplier and another Division Z. Within the same group, under this agreement, the external supplier agrees to buy one product unit from Division Z at a profit of rupees 4 per unit to that division for every component which Division B buys from the supplier. So transfer price division can be taken on the following basis. Here what they have done is they have given us market price that is rupees 10. So division Y currently is buying from an external supplier rupee 10. There is one more division, that is division Z, which is coming up with the same offer. So under this agreement, external supplier agrees to buy one product unit from division Z at a profit of rupees 4. Okay, so we are supposed to answer them which one is the more beneficial to us. So transfer price under situation 1 is nothing but my marginal cost. How to calculate this? 50,000 is given to me as my units, and 2,50,000 is my variable cost. So 2,50,000 divided by 50,000 will give me marginal cost per unit plus opportunity cost. How to calculate opportunity cost? The one foregone by division X. One foregone by division X is nothing but my opportunity cost. So opportunity cost 5 rupees plus marginal cost, that will give me rupees 10. So rupees 10 is my selling price. Okay, my transfer price. Then comes in this situation, situation B. In this situation, transfer price will be worked out as under. So marginal cost is given to me, that is 2,50,000 divided by 50,000. So that is 5 rupees. Contribution is given to me and profit foregone by division Z. So if I add all those things, I'll be getting 14 rupees as my transfer price under situation B. Okay. Hope you are clear with the concepts discussed in this video lecture. If you are comfortable with the lecture, please like, share and subscribe to the channel. I'll be coming up with one more video lecture wherein I'll be continuing from sum number 13 to sum number 18. Thank you.